One of the key skills that can help you achieve financial success is investing. Investing is the process of putting your money to work for you so that it can grow over time and generate income. There are many ways to invest, but one of the most accessible and popular options is the stock market. The stock market is a place where you can buy and sell shares of companies that trade publicly. By investing in the stock market, you can benefit from the increase in the value of the companies you own, capital gains, the payments they make to their shareholders, dividends, and the effect of earning interest on interest, compounding. If you want to start investing in the stock market, you have two main choices: self-directed investing or robo-advising. Self-directed investing, also known as do-it-yourself investing, is when you open an account with a brokerage firm and make your own investment decisions. This option gives you more control and flexibility, but also requires more time and effort. Before you choose a broker, you need to think about your investment style, goals, and preferences. For example, are you looking for growth or income? Do you prefer individual stocks or exchange-traded funds, ETFs? Do you want to invest in the US, Canada, or other countries? However, if you find self-directed investing too complicated or time-consuming, you can opt for robo-advising. Robo-advising is when you use an online platform that automatically creates and manages a portfolio for you based on your answers to a few questions. These questions typically cover your risk appetite, your financial goals, and your personal information. Based on your answers, the robo-advisor will assign you a portfolio that consists of low-cost ETFs that diversify your investments across different asset classes, sectors, and regions. All you need to do is fund your account and set up automatic contributions. The robo-advisor will take care of the rest, such as investing your money, rebalancing your portfolio, and reinvesting your dividends. For this service, you will pay a small fee, usually a percentage of your assets under management. The advantage of robo-advising is that it is simple, convenient, and cost-effective. You don't need to worry about picking stocks, researching companies, or watching the market. You can just sit back and let the robo-advisor do the work for you. Once you reach your goal, you can withdraw your money and set a new goal. Maybe your goal is to invest in real estate, which is another popular and profitable way to invest. Real estate investing is when you buy a property and use it to generate income or appreciation. There are different ways to invest in real estate, but they usually require more money, expertise, and involvement than investing in the stock market. One way to invest in real estate is to buy a property and rent it out to tenants. This way, you can earn a steady income from the rent, while also building equity in your property and benefiting from its appreciation over time. However, you also need to deal with the costs and responsibilities of being a landlord, such as maintenance, repairs, taxes, insurance, and vacancies. Another way to invest in real estate is to buy a property and fix it up, then sell it for a higher price. This is also known as flipping, and it can be very lucrative if you have the skills, knowledge, and capital to do it. However, you also need to deal with the risks and challenges of finding a good deal, financing the purchase and renovation, managing the project, and selling the property quickly and profitably. Real estate investing is not for everyone as it involves a lot of work, money, and risk. You also need a team of professionals to help you, such as property managers, contractors, realtors, lawyers, and mortgage brokers. If you don't have the resources or the interest to invest in real estate directly, you can still invest in real estate indirectly through real estate investment trusts, REITs. REITs are companies that own, operate, or finance income-producing properties, such as apartments, offices, malls, hotels, or warehouses. REITs trade like stocks on the major stock exchanges, and they pay out most of their income as dividends to their shareholders. By investing in REITs, you can gain exposure to the real estate market, diversify your portfolio, and earn a steady income without having to deal with the hassles of owning and managing properties. However, you also need to be aware of the risks and costs of investing in REITs, such as market volatility, interest rate fluctuations, management fees, and taxation. Lastly, you can invest in a personal or private business, which is another way to use your money to create more money. There are different ways to invest in a business, depending on your level of involvement and ownership. One way is to invest in someone else's business, either as a partner, a lender, or an equity holder. This way you can share in the profits and growth of the business without having to run it yourself. However, you also need to do your due diligence, assess the viability and potential of the business, and negotiate the terms and conditions of your investment. Another way is to buy an existing business, either in whole or in part. This way you can take over a proven and established business with an existing customer base, revenue stream, and reputation. However, you also need to evaluate the financial and operational performance of the business, as well as the market conditions and competition. A third way is to start a new business, either from scratch or from a franchise. This way you can pursue your passion, vision, and creativity and build something from the ground up. However, you also need to deal with the challenges and uncertainties of starting a new venture, such as finding a niche, developing a product or service, attracting customers, and managing cash flow. As you can see, there are many ways to invest your money and grow your wealth. Each way has its own advantages and disadvantages and requires different levels of knowledge, skill, and commitment. The best way to invest depends on your personal situation, goals, and preferences. No matter what way you choose, you need to educate yourself, do your research, and make informed decisions. Investing is not a get-rich-quick scheme, but a long-term process that requires patience, discipline, and consistency. By investing wisely and regularly, you can achieve your financial goals and secure your financial future. Before you invest in a business, you need to do some homework. What kind of business do you want to start? Do you have a product or a service that people need or want? Will you target a local or a global market? How will you make money and cover your costs? You need to write a business plan that outlines your goals, strategies, and financial projections. You also need to find a way to fund your business, since it may be difficult to get a loan in the first 2 years. You may have to use your own savings, sell some assets, or look for investors. You also need to take care of some legal and administrative tasks, such as registering your business name, choosing a business structure, registering for taxes, getting a business license, buying insurance, and hiring employees. If you want your business to succeed, you also need to improve your financial literacy. We have already talked about earning income and investing in the last video I posted, but there is another key component of financial literacy: saving. As we said before, you can earn a lot of money, but if you don't save any of it, you won't be able to achieve your financial goals or build wealth. And if you don't save, you won't have money to invest and grow your wealth. So how do you save money? It's simple. Spend less than you earn. The difference between your income and your expenses is your savings. But it's not always easy to do that. It's hard to spend less than you earn when you don't know how much you spend. That's why you need a budget. A budget is a plan for how you spend your money. There are 4 main categories in a budget: your needs, your wants, your debts, and your savings/investments. There are many different budget templates and tools that you can use to track your spending. One of the easiest ways is to use an account that has money management and budgeting features. When you start tracking your spending, you can see where your money goes and where you can cut back. You can also increase your savings by paying yourself first. This means that as soon as you get paid, you put some money into your savings account and then spend the rest. If you do the opposite, get paid, spend money, and save what's left, you might end up saving less. So pay yourself first, and if you have some money left after your spending, save some more. To make paying yourself first easier, make it automatic. Set up your account so that when you get paid, some money will automatically transfer from your checking to your savings account. And speaking of savings accounts, you want to get the best interest rate possible. Another thing you should consider is when to save and when to invest. Savings are for emergency funds and short-term goals like buying a car or going on a vacation. Investing is for long-term goals like retirement or your children's education. Investing can give you better returns, but it also involves more risk. This is where risk tolerance comes in. Risk tolerance is how comfortable you are with the possibility of losing money. Some people are more risk-averse, meaning they prefer safer investments with lower returns. Others are more risk-seeking, meaning they are willing to take more chances with higher returns. You need to know your risk tolerance and choose investments that match it. Hope you found this video valuable. Kindly like, share, comment, and subscribe to our channel for more valuable content like this.